What is up, my peeps? Joshua Smith here with another GSD Mode podcast real estate tip. And today I want to talk to you about the real estate market, the changes that we're seeing, the changes that are taking place. Is the market going to crash? Is it not going to crash? And most importantly, what to do as a real estate professional. So as an agent, team leader, or brokerage owner to go out there, adapt, pivot, shift accordingly, to go out there, navigate whatever is to come. So then that way, not only do you survive whatever it is that's going to take place, but to ensure that you go out there and thrive and crush your real estate goals regardless. So how to go out there and make these shifts, how to go out there and make these moves, because it's really important to understand is that the market itself does not dictate your results and your successes. You and you alone dictate your overall successes. So I don't create these podcasts when I'm talking about the real estate market. I'm not here to go out there and fear monger. I'm not here to go out there and toss fear porn at people, to go out there and create fear and whatnot. It's just, hey, let's go out there and be prepared. I'm a big believer in operating from a hope for the best, plan for the worst. If worst case scenario then doesn't happen, you're good to go. If it does happen, hopefully you plan correctly and you are good to go. But either way, and this is really important to understand, because I don't want you to have fear of whatever the changes that are going to take place, whatever they are. Change is inevitable. Change is something that's always happened, always is happening, always will happen. So why have fear over something that we know that is always going to be taking place? But then from there, if we then learn to not fear change, but instead to embrace change and go out there and pivot and shift accordingly, well, then boom, we're going to go out there and succeed. It's not the strongest that survived. It's he or she that adapts to those changes in the most effective and efficient ways that goes out there and crushes it and goes out there and survives. And I just know this from personal experience, man. I've been doing this 18 years. I've seen now to the two biggest market booms, bubbles in real estate recorded history. I've also experienced the biggest crash in real estate recorded history in my 18-year span of time. It's been a pretty wild ride over these 18 years. And my business has been able to grow and thrive regardless. But I've been able to spot the different markets, spot the different changes, adapt and pivot and shift accordingly. And I wanted to create this today for two reasons. Number one, it's been a minute since I've talked about the overall state of the market on one of these podcasts. Number two, I'm starting to see an abundance of content being pushed out there from other realtors, team leaders, coaches, whatever you name it. Everybody's a guru now today. And I know that might sound oxymoronic because I'm out here, claiming that, I know some things too. But anyway, I'm seeing a lot of content, whether it be on YouTube or podcasts or on social media, that goes something like this. Oh, the media and everybody said the market was going to crash. Like, where's your market crash? I'm not seeing the market crash. It hasn't crashed. It's not going to crash. And people coming out there and almost poking fun, of those that were concerned about the crash. Or that were maybe even predicting a crash. And then coming out with this high level of certainty that this thing isn't going to crash. Now, one thing that I want to point out that's really important to understand, if we look at, the last market crash that we saw. So if we look at the last peak, and I'm just going to speak to my market, every market follows a slightly different trajectory. But here in Phoenix, Arizona, which was one of the biggest boom areas during the last boom crash cycle. So one of the biggest booms, followed by we were one of the hardest hit markets throughout the United States during the great financial crisis. Now, we peaked in about May of 2005. And then, the market slowly had its unwinding process and didn't really fall off of a cliff until 2008. So it's really like this 31-month buildup progression before, we saw Lehman Brothers collapse, Bear Stearns collapse, and just a wave of foreclosures hitting the market. It was a 31-month process. So with real estate's kind of like the Titanic with it moves slow. It's not like the stock market that just have these big spikes, these big peaks, valleys very quickly. The real estate market moves slow. And again, I'm not here to sit here and say that it is going to crash. However, there are a lot of indicators that I'm going to share with you today that make me believe that this thing absolutely could crash. And this thing absolutely could be bigger than the great financial crisis, which was the biggest housing market crash in recorded history. When I'm seeing a lot of these behind the scenes things, I'm seeing, a lot of evidence that this thing could get very ugly. Now, I'm not sitting here, and this is very important, I'm not sitting here saying that that is exactly what's going to happen, because there's so many factors that are out of our control. For me to make these, wild predictions or say it's going to go one way or other, it's just me tossing a coin. Like at the end of the day, I have no idea what's going to take place. It takes place. It's out of my control. It's out of your control. It's out of anybody else's control. It's going to be what it's going to be. However, my philosophy, and one of the reasons why I've been able to continue to grow and scale my real estate business for 18 years straight, regardless whether it's been a boom, bust, crash, anything in between, is because I hope for the best. I plan for the worst, right? I read the markets. And again, I hope for the best, plan for the worst. So if I'm planning on this thing eventually coming down, crashing, this house of cards that there's a high probability that we are in right now. Well, if I'm preparing and planning for this to be the worst housing market crash in recorded history, and it doesn't happen, well, then boom, I'm good to go. Then if it does happen, hopefully I have planned and prepped accordingly, and I'm also still good to go. All right, so I'm going to jump into this here and jump into some of the things that I'm seeing, and then we'll get into, again, things to go out there and do to navigate to ensure that you create success regardless of the marketplace. But before I do, make sure that you go check out gsdmode.com for more free training, more resources. You can check out also about my coaching mentorship program on there. You can learn more about Perfect Storm, which is the #1 most effective and efficient and cost-effective website CRM all-in-one system out there to help you grow your business. So again, go check out gsdmode.com. All right, so I'm going to break down. I got a whole list of kind of the main things that I'm watching, where I think that a lot of these people that are coming out right now and sitting there saying, "Oh, the market is a crash." Well, where's your guys' market crash? I'm not seeing any evidence or signs of those. It hasn't happened. It hasn't taken place. It's not going to happen. At least I'm not saying I can't get into their minds, but at least the evidence that I am seeing them talk about, whether it be on social media, YouTube, whatever, is very superficial. And that's not a dig at them. I get why they're looking at those things, because they're looking at the evidence of the market itself, like what's actually taking place right now in the market. And we are seeing the market being stabilized. It's being propped up. It's being artificially propped up, which is really important to note. Like, this is an artificial economy. It has been for the last 16 years. If we didn't have this artificial economy right now, which just means kind of infinite crazy QE and monetization of debt, and like we haven't had a real market in 16 years. All of this has been subsidized through quantitative easing, monetization of debt. So essentially all through bailouts. We would be in a 16-year-long depression economically right now if it wasn't for all this behind the scenes shit. So we are in a very volatile time. Probably, at least from any evidence I can see out there, the most volatile time that I've ever seen in history when it comes to the overall economy and the situation that we are in. This is why I don't believe that we are even close to out of the woods yet with this thing potentially imploding. And like I said earlier, I don't know if it's going to. I don't have a crystal ball, but I'm not going to allow myself to get overly confident or overly arrogant or whatever, to sit there and think that this thing couldn't flip of a dime just come down again, because this with all this artificial economy, it's this house of cards. Now, can they keep this together? Maybe, maybe not. I don't know. It's bigger than me. It's bigger, out of my control. So again, I'm going to hope for the best, plan for the worst. But look, let me start breaking down some of these KPIs that I'm paying attention to. And there's a lot more than just what I'm going to go through here today. But these are kind of the main things that I'm looking at. Okay, so let's first talk about inflation. Now, if you want to go out there and buy into the CPI data that we get delivered to us and believe that that's true inflation, meaning that that's all that life has went up. So if we look at that, okay, since between 2021, 2022, not even counting 2023 so far, life is 16% more expensive than it was in 2020. So like before COVID, like since COVID dropped, life is 16% plus more expensive today than it was prior to that. But when we get these inflation reports, we hear a lot of things in the news like, oh, it's the worst inflation that we've seen, since the kind of 70s, early 80s, that decade of inflation stagnation time frame. We get all these comparisons to that time frame. Well, the only way, in my mind at least, to truly go out there and compare today to those times is if we calculated those off of the same models, right? But when we calculate, you got to understand during the Clinton administration, they changed how they calculate the models to go out there and skew the numbers. So if we look at, inflation, like, okay, inflation right now is what getting reported at like 5%. So CPI inflation. Well, if we look at and we calculate them on the same models that we use to calculate inflation's Clinton's administration. So if we were to compare it for like during the the 70s and 80 time frame, early 80s, during that time frame, which is we're getting all those comparison data now. As of right now today, true inflation would be 12.94%. So from April of 2023, from a year prior to April 22, inflation's at 12.94% up in that time frame. So then if we look at and calculate those same models, then we're looking at life today being about 30% or more expensive today than it was about 2.5 years ago. And like, just do your own equation on that. Like, when you go to the grocery store, when you're going to the gas pump, when you're paying your bills, when you're going out there eating out, when you're going out there and buy shit, do things seem only like 15-16% more expensive than they were 3 years ago, or more like 30%. Like, we feel it, we see it. Okay, so with that being said, when we got the cost of just life getting more and more expensive, well, that's going to be less and less people that can go out there and afford to buy real estate, afford to continue to maintain the real estate that we have. I hear all the time of things like, oh, well, mortgages that are done, we're not doing the subprime mortgages, we're not doing the ninja loans, we're not doing the stuff that was taking place, before the great financial crisis, so we're not going to have the hardships that then lead to, these more risky borrowers that then, end up in a short sale or REO position. Well, I don't know. Right? Like what leads to a short sale or a foreclosure position is a hardship, right? So then from there, when life is 30% more expensive than people that acquired those homes, okay, well, they were at a debt to income ratio where they could afford those homes, even though their mortgage is on a fixed rate. When everything else is going up, that creates a different type of a gap of a hardship. And that definitely could lead to people having to go out there and fire sell. Then the other thing that I always hear is, oh, well, people have so much equity in their homes. Look, you guys, you got to understand that prices are set on the fringe minorities. So what I mean by this is, if we look at the great financial crisis, so what was there? About 18 total million REO distress sales during that whole entire time frame here in the US. And then there's about 140 million rooftops. So you have 18 million, which is a very small percentage when you calculate to that whole of 140 million, that pulled the whole entire damn market down. So it only takes about 10%. Like, your home value today is determined based on that last sale that your neighbor did or somebody in your neighborhood did. So if you have 5 or 10% of a neighborhood that's having to go out there and start fire selling these properties to just get out of them in a quick enough time, and maybe they still have the equity to do that. Well, this one fire sells, boom, it brings down these prices. Then this one fire sells a little bit under that one, then boom, brings down the prices. Then it doesn't take a lot for this shit to just start crumbling. All right, so then let's talk about unemployment. Now, we know with cost of capital, with what the Federal Reserve's doing, increasing interest rates and continuing to increase interest rates, and they haven't, they've slowed down from 50 basis points to 25 basis points, but they're continuing down this path, and who knows, if and when they're going to pause or pivot or whatever, what the Fed does, like, who fucking knows, right? However, cost of capital today is a hell of a lot more expensive than it was a few years ago. A hell of a lot more expensive than it's been in a long time. And it's continuing to get more expensive. Well, when cost of capital goes up, right, then from there, unemployment always goes up as a result. So, and the Federal Reserve is admitted this publicly, that they are trying to increase unemployment rates. And again, how unemployment rates are purported today is massively manipulated. If we calculate true unemployment rate today, right now, today, or April 28th, 2023, if we calculate it the same way that we calculated during the 87 crash, that we calculated during the 81 crash, that we calculated during the 70s, early 80s, decade of inflation / stagflation, if we calculate in the same way that we did during the Great Depression. So if we calculate it under the same models, true unemployment today would be 24.6%. And it's on the rise. It is going up. Again, they calculate it differently today. They don't count the unemployed in the same way, or the people that you're only calculated for so long on that job search, and then how they calculate the underemployed. All the models have tweaked and different. So when they're saying that, unemployment rate is 3.5% or 3.6% or whatever they're saying that is today, you got to understand that. I'm not saying that that's not a real number of how it's calculated today, but you can't compare that to historic numbers. I mean, we are at right now Great Depression unemployment numbers as of right now today. All right, so then from there, if we look at M2 money supply. So M2 money supply. So when you think of M2 money, just think of this as, okay, it's either cash in your bank account or money that you can quickly get your hands on. So it's just an easy way to think of it. Something that can be, maybe they're assets that you own, but you can cash out of those quickly and have that check in your hand within, I don't know, maybe a week or whatever, that is. So that's M2 money supply. So M2 money supply, now this is a result of the quantitative tightening and raising capital that Federal Reserve's done. Well, M2 money supply is now negative for the fifth. Now M2 money supply. So the contraction of this is the fifth time that this has happened in recorded history. So since the inception of the US dollar, this has only taken place 5 times. The last time that it took place was right before the Great Depression. Every time M2 money supply has went negative, it has resulted in a depression. Well, before the Great Depression, they called them panics. So they're always changing language, right? It was called panics, and they're like, oh, well, panics, that doesn't sound so good, so let's call it depression. And then they're like, okay, well, depression doesn't sound good, so let's call it, a Great Recession. Now they're, who knows what they're calling it now? Now they're not saying recession, soft landing. Who knows how they tweak these verbiages? But regardless, every time, so 5 times that this is taking place, and we're talking over spans of hundreds of years. It's always been followed by a depression. Now, I'm not saying that we're going to have a depression. I don't know. We didn't have essentially MMT monetary policy at that time, like we switched to, where it's just like the Federal Reserve is just went crazy with the money press. I mean, they're already, they're supposed to be on this, quantitative tightening. They've already resulted back to quantitative easing with all these bank bailouts and all the stuff that's taking place right now. So who knows if they just want to continue this artificial economy and print money, continue printing money. But you got to understand that printing money is no different than during the Roman time. Times of the Romans, like think of it as gold coin. You have this gold coin and however many ounces of gold that coin was. Well, then they're like, okay, well, we can dilute this if we just add a little bit of copper to it and less gold. Now we'll trick the people. The people won't know, but it diminishes that value, right? So it's counterfeiting the money supply. That's all this is. So you got to think we're going through 16 years now of straight counterfeiting of our money supply, in diluting our money supply. So life, it leads to inflation, leads to other things, life getting more and more expensive. Okay, so then also, right now, if we look at the insane inversion of U.S. Treasury bonds. So we trade like a healthy Treasury bonds is like, okay, your 3-month is paying a less interest rate than your 2-year, than your 5-year, than your 10-year, than your 30-year, which would make sense. If I'm going to give the government and buy the government's debt, and I'm going to allow them to hold up my money for 30 years, well, you think then I would get paid more interest on that than I would on a 10-year or 5-year or a 2-year or a 3-month. Well, look at the inversion that it is today, right? It's massively inverted. It's actually the most extreme inversion that we've seen since the 81 crash. When you look at like the 3-month and 10-year and 2-year and 10-year, and over the last 50 years, since this has become an indicator, U.S. Treasury bonds and the inversion has been one of the most accurate predictors for the last 50 years of recessionary timeframes, meaning contraction of growth, contraction of GDP, contraction of, and so forth. Now, one thing that I want to say is, okay, we may go into a recession, but that doesn't necessarily mean that the real estate market's going to crash. Right? We've had recessions before where the real estate market's done fine. I mean, all recession is just shrinkage in GDP, right? So just negative GDP prints or GDP going down, with that. So so maybe if the U.S. bond market, if this accurate predictor of the last 50 years is accurate, showing that, okay, we're going to go into a recession and maybe a hard recession. Doesn't necessarily mean that the real estate market's going to crash. We don't know, right? We have evidence from before that hasn't taken place. All right. So then in 2023, the year that we are in right now, We got the largest year-to-date business bankruptcies since 2010. So we are seeing insane amounts of business, BKs and business closures. So right now, an average of about 10 business closures per day, about 2,400 layoffs per day right now. And I know a lot of this stuff doesn't get reported on the news, but if you look at and think of the government is a big business, right? Like Mark Twain said the government was just the first big business to ever exist. So if you think of the government as just a big business, a big corporation. Okay, well, if you've got this business that behind the scenes is in trouble, right? So think of, GDP for our economy as, the business revenue for that business. Okay, maybe behind the scenes, the business is not doing well at all. Well, is that CEO going to go to their employees and be like, oh, guys, we're in some freaking trouble. We got 30 days of reserves left in the bank. If we don't turn this ship around, we're going to start missing payroll. Like, we're going to have to start doing mass layoffs. We're going to have to. No, they're not going to go out there and do that because everybody will freak out. Everybody will go out there and look for other jobs and alternatives. So what's that? What is the leader of that business going to do? All right, guys, like we got to, like they're going to get everybody riled up. Like the future's bright. The future's amazing. Things are great. We're in a great position. Let's go out there and dominate. They want to get everybody riled up and get behind the mission, behind the cause. So of course we're going to get told, oh, things are great, things are strong, economy's strong, employment's strong. Like, they're not going to come out to, like if they came out and just said, hey guys, just imagine you get this press conference, from the president, comes out and is just like, all right, man, dude, guys, like we're in some trouble, man. Economy's going to be shit. It's going to be some rough years ahead. You need to prepare for this hard crash, this hard landing. Like this is going to be gnarly. And I want you guys to brace for impact because it is going to be a difficult next few years. Okay, what are you going to do when you hear that news? If that news was purported to you, you're going to freaking, probably pull some money in the bank, put some money in the safe. You're probably going to stop spending right away. You're going to probably, you're going to contract right away. Well, they want us spending because that's their business, right? Okay, so then from there, I heard talk about 2,400 job layoffs per day. Then when we look at the car repo market, a lot of people think that the subprime loans haven't been done. Well, they have been done, just not necessarily in residential real estate. There's been a lot of abuse with subprime loans in the commercial real estate industry. And there's been even more so abuse in the subprimes with the auto industry over the last several years, to the point right now where the auto industry is in free fall collapse and has been for some time now, to the extent of 15,000 plus daily car repos taking place. And then from, when we start looking at that, what are the banks doing? Well, the banks, as they're repoing these cars, they're just going out and storing these cars. They're not taking them to auction like they're supposed to do, because the second they take them to auction, they realize that loss on their balance sheet, and they are severely freaked out that will set them into a liquidity crisis. And liquidity crisis is essentially what happened that led to 2008's great recession. It wasn't subprime loans might have been, a part of it. There's a lot of a lot of people like to just go out there and think of, is this one thing that caused the great financial crisis, or this one thing that caused the Great Depression? No, usually it's a conglomerate of things, that all kind of added up that led to the implosion. One of those things might appear to be the straw that broke the camel's back, but isn't usually like the only thing, right? There's a lot that goes into these. So you got 15,000 daily auto repos taking place. And again, banks not going out there and taking those to auction because they got to realize the losses and they're freaked out if that puts them into a liquidity crisis. Now, one thing that I haven't talked about that was important to note, and if you've been watching this podcast a long time, I was predicting a potential market, correction / crash. Now let's just get clear on definitions here. A correction is below 20%. A crash is above 20%. So, there's some markets throughout the U.S. that have already crashed. Some people are like, where's the housing market crash? Well, we've already seen some markets that have dipped. When you look at, the amount of depreciation that they've already had, and then you stack on that inflation, you do that calculation, they're already in a technical crash. So we've already have some markets that maybe some of you are in right now that are listening to this, and your market's already crashed. So I wanted to just be clear with that. Okay, well then 5 months before COVID hit, there was a banking liquidity crisis that was of a bigger magnitude than the great financial crisis. It actually was a bigger bailout, as far as bailout in financial terms, that the Federal Reserve had to go bail out these banks 5 months before COVID. The reason you didn't hear about it, the reason you didn't see it or feel it, is because the difference is this time they were ahead of it. Yeah, right. So they went out there as a $6 trillion bailout 5 months before COVID lockdowns took place. So when people are like, oh, well, then, shit's strong, whatever, again, it's all artificial. They're like, we're playing with monopoly money right now. Like, businesses are in bad shape. The average family's in a bad shape. We look at balance sheets of the average family, the average business, they're all in a bad shape. And the government's in bad shape too. And this isn't just a US problem, this is a global problem. US is probably in the best position out of any other country. As bad of a position that we are in, we're probably just the nicest home in a bad neighborhood. When you start thinking of this, so who knows? I don't know what this is going to start looking like. Okay, when China's economy implodes, or one of our other big trade partners implodes, what all of that looks like. But just understand that this is like, I don't truly believe that this is a new problem. I truly believe, from all my research and all my due diligence, that this is just a continuation of 2008. I think that they just band-aid shit, have been band-aiding everything together as much as they can to try to hold this together. And we've had some ups and downs and stop the bleeding, and then it bled, and then they plugged the holes, and then, so it appeared to be healthy for some time, whatever. I think that this was just, the shit broke in 2008, and they've just been trying to just patch it together since. At some point, we're going to have to face the music, because we never truly face the music. Because again, like I said earlier, if you look at just GDP growth, if we remove away all the quantitative easing and all the monetization of debt, so all the artificial money that's been created or pumped in, I guess it's not artificial, it's real money that was created out of thin air, that's been pumped in the system, we would be on an average of about 1% GDP decline over the last 6 years. So a 16-year depression that we'd be in right now. Okay. So then we got bank crashes. You got SVB Bank. You got First Republic, and this is more than likely just the beginning stages of banking crashes. And if you want to know more about that, okay, go read Creature of Jekyll Island, about the inception, and if you want to learn more about the Federal Reserve and whatnot, it's like, okay, they're on a mission to go out there and consolidate banks. And my guess is we're going to see a lot more of these banks going under and crashing with the economic climate that we are in, emerging of, so there's just going to be less and less banks, more mergers, taking place. So kind of the beginning of the potential banking crisis that we're seeing right now, with more and more regional banks going under. We got all-time high consumer debt, corporate debt, government debt, and not just here in the United States, on a global market. And if you look at the euro dollar, so if you think of the euro dollar, that's just every single dollar that's outside of the United States, which is over 90% of all the dollars out there, right? It's a very small minority that's actually held within the United States. It's just insane, the amount of debt. If you look at like the derivatives market, nobody actually knows how much debt is tied up in the derivatives market. The best guess for calculations is over $2 quadrillion. But when you calculate up just government debt throughout the globe, which on balance sheet debt is well over 300 trillion, it's an impossibility. It's mathematically an impossibility to ever be paid back. And that's just on balance sheet debt. So when you look at, okay, like the US government on balance sheet debt, like what's the debt, 35 trillion or 30 trillion, somewhere around there. I don't pay attention to debt. You can go to the US debt clock and see what that is, but that's on balance sheet debt. Off balance sheet debt are their other liabilities that they have. And best calculations are that that's probably like closer to 100, 150 trillion. When we look at that, but we look at consumer debt, all-time high consumer debt. And one thing to think about when we look at consumer debt, well, look at all, what's the highest debted thing outside of mortgages when it comes to consumer debt? So the credit card debt, is it medical debt? Is it, no, it's student loan debt. Well, how many of these student loan debts, you got about 1.6 or $1.7 trillion of student loan debt that's out there. How much of that is still in forbearance? A huge chunk of it. Okay, well, when that kicks in, what is that going to do? Now that people are feeling all this inflation, they're already maxed out. When you look at, so if you look at like the savings and to debt ratio, it started to equalize, through all the stimulus, through all the bailouts that took place, with the lockdowns and whatnot. And then it got to the point where, okay, savings started, going up and up and up. But now, over the last 2 years, it's just split where, debt's just skyrocket. If you look at the graph, just think of a skyrocketing graph up. And if you look at savings, just skyrocketing down. So we're, record low U.S. consumer savings, record high U.S. consumer debt. And then people are like, yeah, but that's because of mortgages, and interest rates are so cheap though. So yeah, they're taking on more mortgage debt, but the payments are affordable. No, I mean, you could factor that in when we look at debt, but also look at just credit cards, look at other forms of debt, whether it be auto debt, which is through the roof and continuing to grow with credit card debt, like to the point right now where the average American is just holding on to pay the interest. Credit cards are maxed out and they're just paying the interest, on that debt. But so we got all-time high record consumer debt, business debt, and government debt. So we are in the biggest debt bubble that we've ever seen, not just here in the US, but globally, on magnitudes of scale of size bigger than we've ever seen before. And that's a lot of, if you look at a lot of high level minds out there, that's why they are so scared and thinking that like this shit's going to crumble. Like it's just something that we've never seen before because they're so freaked out of this crazy, insane debt bubble. All right, so I already talked about, 16 plus years of QE and monetization of debt. Otherwise we'd be in a depression. Then we factor on that. Okay, well, this possible World War III, this war that we are in with Russia. Now people are like, well, we're not in a war with Russia. It's Ukraine versus Russia. We're just supporting them. The way I look at this is, okay, man, maybe, I'm me and another dude across the street, and you're on the other side of the street, and the guy that I'm with or the person that I'm with is just pitching rocks at you, just whipping rocks at you, tagging you with those rocks. Right now, I'm just handing them the rocks. Right. So, but I'm saying, oh, I'm not in this. I'm not in this rock war. I'm not in this. Like, I'm just handing this person the rocks. I'm just handing them the ammunition. I'm not in that. Well, I don't know. I mean, that's the way we might perceive it, or our government might perceive it. But how does Russia perceive this? How does China perceive this? There's war games going on right now preparing for a potential war with China for 2027. So how is this? We're in the biggest hot war that we've seen in Europe and since World War II. Like, what does this do? What does this look like? I mean, wars are very inflationary. So does this then make our cost of life go up more and more and more? Like, what does that do? I don't know. I'm just, I have no idea, but to me, I'm just sitting there looking at this thing. Okay, well, how's this going to impact everything? We already know it's going to impact food prices because of the wheat and grain and fertilizer that's off market and those things. It's not like we can just produce those overnight. Those things take half a decade or so to get online and get going. And so when you look at between Ukraine and Russia, known as the breadbasket of the globe, that's going to, again, lead to other inflationary things, potentially. I don't know, but I'm just sitting there bringing this up as a thing of, when people are like, well, dude, like this shit's going to be fine. It's not going to crash. The economy's so strong. The market's so strong. Like, for you to sit there and think that the real estate market is not going to crash or not going to be impacted and continue to be so strong, then you have to then be under the belief that the economy is going to continue to be strong. Right? Well, is the economy strong? Like, the economy is not strong. It's propped up by a bunch of fake bullshit, and we'll see where this goes. Right? Okay. Well, then if we look at like S&P 500, you got 40% of the S&P 500 companies are zombie companies. What a zombie company means is that they can't even service the interest on their own damn debt unless they're getting, like, they need new rounds of funding to even go out there and operate. Right. And this is why we're seeing, so many, I said earlier, the largest year-to-date BKs of large business bankruptcies since 2010, because they're insolvent companies unless they keep getting new rounds of funding. Well, cost of capital goes up. And also, if you look at VC firms, they're intelligent. They see the writing on the wall. They're being a lot more cautious right now. It's just not free money being handed out all over the place. So if that funding stops or continues to slow down, like, okay, well, you got 40% of the 500 largest companies in the United States that could implode at any point, with that. Then, if we look at, okay, on a big scale, all right, we're experiencing deglobalization for the first time in our lifetimes, any of our lifetimes, right? We haven't seen deglobalization really take place since the collapse of the Roman Empire. So what does that mean? So so World War II happens, Bretton Woods takes place. We come up with an agreement because we had the strongest military at that point. We also had the strongest currency at that point. So we came up with an agreement that we would become the world's reserve currency. Then from there, we came up with an agreement that we would then leverage our Navy to become the world police. So then everybody, the rest of the globe, could partake in safe, essentially free, safe trade and everybody could grow, everybody could expand, everybody could get rich together. China wouldn't exist in the way it exists today if it wasn't for this agreement, right? Like everybody was able to go out there and share in the wealth and get rich together. Well, it wasn't, we didn't just do that to go out there and do it. The United States did that with the leverage component that, the rest of the world would essentially ally with us to go out there and break up the Soviet Union during the Cold War, right? Well, that's been done for, 30 plus years now. I might as well, so, we've been unwinding this globalization. So now we're going into this whole deglobalization area. So there's no longer going to be the safe free trade that exists out there. There's going to be, different, it's almost like gangs, like different partnerships. That's why you're seeing, like BRICS come together and, people situating different trading partners and whatnot. What does that look like? What does this look like when, okay, we are not doing business with China anymore, and China is no longer a friend, they're considered an enemy, and we're not doing, the same international business that we've been doing for so long, other than with positive swap line ally partners. Like, what does that look like? I don't know. And I'm not saying that I have the answers to that. I know that over time, it's going to bring a lot of manufacturing here back to North America, which long-term will be a good thing. But what does that look like as we're going through it? It's probably going to be very inflationary. I mean, I've heard certain reports that we're going to have to double our manufacturing and industrial footprint here in the United States. Okay, well, building all of that up, that's going to be very inflationary. Cost of life going up, whatever, could create some good jobs, right? But also can hurt others, as we're going through that. So long term, it could be a great thing. But what's the pain that we're going to have to go through to it? And again, I'm not saying that I have the answers to these things, because I don't think anybody does. It's very hard to predict certain things, that we've never experienced. We've never experienced potential World War III yet, right? We've never experienced this deglobalization that we're going through right now. We also are going through demography worldwide shrinkage. So what that means is we've now hit an inflection point where no longer is the population expanding. So now we're going through, okay, when more and more people continue to have more kids and population growth continues to happen, okay, it's easy to go out there and grow. It's easy to go out there and print endless amounts of money, because next year's going to grow more. Like, you're just guaranteed to have GDP growth year after year after year. Well, now it's the opposite. If you look at, like, outside of the US, almost nobody has a healthy demography. Our boomers here in the US had kids and had millennials, but pretty much nobody else did that. Like, okay, if you look at China, China is the fastest aging demography to ever exist in recorded history. So they'll probably lose, there's predictions out there that they'll lose about half their population by about 2050, 2060. So they have more 80-year-olds than they have 70-year-olds. They have more 70-year-olds than they have 60-year-olds, more 60-year-olds than 50-year-olds, and so forth. So it's an inverted demography. So what does that look like? How does that impact everything? Well, I look at that and my own mind tells me, well, that's very deflationary. So inflation is when prices of everything goes up. Deflation is when prices of everything go down. I look at that as a deflationary thing. I don't know what that's going to look like. I don't know. I'm not making predictions saying that's what's going to happen. But I look at that and I'm like, well, fuck, dude. Like, okay, it's the first time in any of our lifetimes that we've ever experienced that as well. Then also we're in this green movement. The whole Green New Deal, that AOC wanted to push through, that you probably heard on the news at one point. Well, that has been passed. It's just under a different name, called the Inflation Reduction Act, called the the new infrastructure bill, so like, okay, what does it look like and how do costs go up as we're going through this whole new green movement and all these new mandates for, the green movement that we are going through? What does that look like? Probably going to be very inflationary. So, cost of life gets more and more and more, which means the average person, the average American is going to have less and less to go out there and buy shit and maintain, the quality of life that they have. So who knows where all of this is going? But when I look at all of these things, and there's, other things that I'm paying attention to here, but these are kind of the main big things. I'm like, hey man, like, we are in very volatile times, probably as volatile as we've ever seen in at least any element of history I've been able to get my hands on and go out there and research and study. So this is why I'm not so quick to say, oh, well, fuck, dude, the market hasn't crashed yet, so it's not going to crash. I'm like, okay, like there's, okay, 5 months before COVID should have crashed, right? But it got bailed out injection of just $6 trillion printed and created out of thin air to save that. Otherwise, we would have had another great financial crisis or worse. Yeah, right. Then, okay, we have all these lockdowns. Economy, like, I mean, you have about $90 trillion printed globally through central banks all throughout the globe during that time frame to prop everything up. Okay, it would have massively imploded and crashed then. It shouldn't have went up then, but it was artificial. Okay, now we're starting to see these banks crashing, because of the quantitative tightening. Well, there's a lot of reasons as to why. So, but then, okay, what happens again? Bam, now just quantitative easing. So out there and save those. So it appears, and not that it appears, it things haven't, we haven't seen the corrections or crashes because of all these freaking bailouts. But then, okay, you might just be like, okay, well, they're just going to infinitely bail everything out. Maybe, right? But eventually you got to face the music. There's been 500 fiat currencies before the US dollar. They've all suffered the same fate, meaning those in power couldn't control the printing press, infinite QE, infinite, exactly what we're doing right now. Well, eventually that dilutes to the point where it's unsustainable, and then it all comes crashing down. Right? So they've all suffered the same fate. So there's consequences to that too. They may be able to kick the can down the road another decade, 2 decades. Who knows how long that's going to be? But there's consequences to that too. So with all that being said, again, I don't know what's going to take place, but I am not one that is going to write this off and be like, oh, the market's good. All these other people, you got a lot of smart minds out there, that made a hell of a lot more money than me and you. And there's smart minds out there, just singular people that have made more money than me, you, and everybody that will ever watch or listen to this podcast combined, that is having some big predictions right now, or that are having big predictions of this thing imploding and this thing getting gnarly and ugly. So why would I go out there and discount those? But again, they could be wrong. They could be right. They could be wrong. Could be somewhere in the middle. I don't know. But I'm going to go out there and prep and plan. So again, hope for the best, plan for the worst. If worst case scenario doesn't happen, you're good to go. If it does happen, hopefully you plan correctly and you are still good to go. All right, so now let's pivot and transition. I'll make this quick because I know I'm going long here. But what to go out there and do to prepare for this? Okay, number one, pay attention. Pay attention to what's going on in your market. You might still be getting multiple offers, but are you getting less multiple offers? Is the rate of appreciation in your market slowing? Is the days on the market slowly going up, right? It could be changing before your eyes. What I saw in like when 2008 hit, I had so many agents in my market that were like, oh, well, nobody saw this coming. It got hit so hard and I had to drop out of the industry because nobody saw it coming. And I was like, how did you not see this coming? Luckily I had some good mentors that taught me what KPIs to pay attention to and how to read markets. I didn't understand how anybody couldn't see it coming. Now, I'm not going to sit there and say I didn't know it was going to be that magnitude. But saw it coming. I saw 31 months of just track. Okay, inventory rate month over month, inventory rate, your absorption rate in your market is the biggest lead indicator of where the market is going, because it's just controls supply and demand in all products, real estate included. It's all about supply and demand. So just paying attention to what's absorbed, what's months of inventory doing. What is the rate of median sales price, average sales price going up, going down? What's that rate of change? Is it slowing? Days on market, just paying attention to those subtle changes. And then from there, so you're tracking your local market, you're paying attention to what's going on there, so you can pivot and shift accordingly. Because if I can sit there and see these trends, okay, well, in 6 months, then we should be at this months of inventory. Okay, historically in my market, what is taking place at those months of inventory? So you can start to sit there and predict, where this stuff's going and start to prep, accordingly, with that. Because it's really important to understand that real estate is always traded hands, always has, always will. So, with all these different market adjustments, like there is no such thing as a good market or a bad market. Market's always good for somebody. It's our job as real estate professionals to identify whom the market is currently good for and go out there and pivot and shift and adapt accordingly to whom that market is good for, right? So we just shift, adapt accordingly, because again, real estate's always going to be trading hands. So pay attention to, okay, based on those rate of changes, then I can see historically in my market, okay, like who have been the buyers, who have been the sellers, who is this current market good for? And plus you're just paying attention to those. You're knowing your market, you're paying attention to your market, having conversations with your lenders, having conversations with your title company. They see more volume than you probably do. So then that way you can go out there and predict and see, where things are expanding, where things are growing, and you just make sure that you shift and adapt accordingly. Now, one thing that we all are experiencing right now is, we experienced essentially the sharpest and the most consecutive month-over-month transaction volume decline really in history of real estate when we combine those two things together. So that means that there are just less people willing or able to go out there and transact in all of our markets right now. And when I say all of this, like you might be in another country listening to this and that doesn't hold true to you, but I know for the United States and Canada, that holds true right now. Okay, well, know what that is for your market. Like Phoenix, I know we're down 39%. Transaction volume's down 39%. Doesn't mean like we just had the first month last month where we actually appreciated in prices, first month in well over a year and a half that we've seen that. We were 2022 was a month of declines. Now we're starting to see things go up. Now, if you look at the graph of stages of bubbles, usually you got it where the market's pretty flat and then it kind of skyrockets up. I know a lot of you listen to this on audio, so just visualize this. Thinking of a graph. It's flat, and that's slowly going up, slowly appreciating. So, 3-4% regular, appreciation year over year. And then all of a sudden, boom, it spikes up. And then the rate of speed that it's going up goes up and up and up. And then it kind of flattens out. Then it starts to curve and then it starts to come down, might come down 10-15%. Then it flattens out again. And then you have this brief period of time where it kicks back up. And it has this appearance, and a lot of people think that is where normalization takes place. The market's corrected. They think, and that's known as a trap. You got traps on both sides, a bull market trap and a bear market trap. And then, once that kicks into place, then boom, it reverts the other way. And then the full crash takes place. Capitulation steps in, takes place, and then people understand that shit. Okay, now we're thick in it. And that could be what we're at right now. I mean, those are, the historic stages of bubbles. Maybe history doesn't repeat itself. Typically it does. Maybe it doesn't this time. I don't know. But again, I'm going to prep and plan, for those things. However, right now, so my market's down 39%. So what does that mean as far as transaction volume decline? Something we're all experiencing. I think nationwide is about 37%, but you can go out there and do the calculations for your own market. Just look at January of 2022 or January 2023 versus January 2022. How many homes closed? Do that division, and I'll give you a rough guesstimate. Rough enough to figure this out. Then from there, okay, my market's down 39% of meaning lesser people willing to transact in my marketplace. Okay, I gotta generate 39% more leads. I gotta do 39% more follow-up, have 39% more conversations to get the same result. So right now is the time. Well, yeah, we ought to all work a little bit harder. Got to be a little bit more focused to go out there and crush it. But this too shall not last forever. Like this too shall pass. Just like all things do. But just be focused, right? Just pay attention, be focused. Don't. And I'm not one to say that. I'm not going to fall into any of these camps. I'm not going to have bias to this of, it's like, I know it's going to crash, or I know it's not going to crash. Like, dude, I'm more intelligent than that. And and maybe that's a bad. I don't want to come across as arrogant, whatever. But Andy Grove wrote a good book that Only the Paranoid Survive. Andy Grove was one of the most successful CEO of Intel, one of the most successful CEOs to ever exist. So what I'm telling you is, be a little paranoid. Not to the point where it puts you in action, but don't allow yourself to get arrogant and cocky of it's going to be one way or another, right? Like, okay, I know that there's too much shit going on for me to know which way it's going to play out. Okay, so I'm going to prep for both ways. And so I'm going to hope for the best, plan for the worst, and I'm going to pay attention to exactly what's going on a high level in my market so I can pivot, shift, adapt accordingly. All right, so I hope that you guys found this helpful. Keep crushing it, keep kicking ass. Remember, success is always internal. It is never external. So the market does not dictate your success. You dictate your success. Don't ever allow yourself to play a victim and blame the market for any lack of success that you are having or any successes that you've had, right? It's up to you, your actions, your focus. You dictate and control your success. So hopefully this was helpful. Again, go out there and check out gsdmode.com for more training, more resources. Keep crushing it, and I will see you next time. Peace.